Psychology and Finance. Introduction. With the development of modern society, the demand for financial management is increasing day by day, and psychology plays an important role in this field. Psychology explores people's thoughts, emotions, and behaviors, and applies this understanding to various scenarios, including the financial domain. Financial decisions and behaviors are often influenced not only by rational factors, but also by psychological factors, which is the main topic of this paper. Psychological factors in financial decision-making include cognitive biases, emotional influences, social pressures, and more. Cognitive biases refer to the systematic errors people make when faced with information, which may lead to irrational financial decisions. For example, overconfidence and loss aversion are common cognitive biases that can lead to excessive trading or improper asset allocation. Furthermore, emotions also have a significant impact on financial decision-making. People may make decisions contrary to rationality when emotionally aroused, leading to risk-taking investments or overreacting to market fluctuations. Financial behavior patterns refer to the financial behavioral characteristics that people exhibit in their daily lives. Consumer behavior and investment behavior are important components of financial behavior patterns. Consumer behavior is influenced by psychological factors such as mental accounting effects and social comparisons. Investment behavior, on the other hand, is influenced by investors' psychological traits and market sentiment, such as risk preferences and sensitivity to losses. The integration of financial education and psychology can help people better understand and cope with financial challenges. By applying principles of psychology, more effective financial education methods can be designed to enhance people's financial literacy levels, thereby better addressing the financial needs of individuals and families. In summary, this paper aims to delve into the influence of psychology on finance, analyze financial behavior patterns, explore the integration of financial education and psychology, and provide techniques to improve financial behavior. Through these studies, we can better understand people's behavior in the financial domain and provide practical solutions to promote the financial well-being of individuals and society. The influence of psychology on finance. The influence of psychology on finance is a broad and profound topic, covering various aspects including cognition, emotions, and behavior. Firstly, cognitive biases are one of the most common and influential psychological factors in financial decision-making. People may be influenced by various biases when processing financial information, such as overconfidence, loss aversion, confirmation bias, and more. These biases can lead to irrational decisions, such as overtrading, ignoring risks, or exaggerating losses. Secondly, emotions also play a significant role in financial decision-making. People's emotional states can affect their perception of risk and their response to market fluctuations. For instance, emotional excitement may lead to excessive optimism or pessimism, affecting the rationality of investment decisions. In addition to cognitive and emotional factors, social factors also influence financial decisions. People may be influenced by those around them, such as friends, family, or social media, which may lead to following others' financial decisions, rather than making appropriate decisions based on their own situations and goals. Furthermore, individuals' psychological perceptions of money and wealth also impact their financial behavior. For example, the symbolic meaning of money, desires for wealth, and fears of wealth loss can all affect people's financial decisions and behavior. In conclusion, the influence of psychology on finance is multifaceted, involving cognition, emotions, social factors, and psychological perceptions. Understanding these influencing factors is crucial for improving people's financial decision-making abilities and behavior. Therefore, researching how to understand and address these psychological influences has become an important direction in the field of finance. Financial behavior patterns. Financial behavior patterns refer to the distinctive financial behaviors exhibited by individuals or groups in their daily lives, which are influenced by psychological factors and reflect attitudes and actions towards money and finances. Firstly, consumer behavior constitutes a significant aspect of financial behavior patterns. Consumer behavior is influenced by psychological factors such as mental accounting effects and social comparisons. Mental accounting effects refer to the tendency of individuals to allocate money into different mental accounts, thus affecting their consumption decisions. Social comparison involves individuals comparing their consumption and lifestyles with others, influencing their own consumption behavior. Secondly, investment behavior is also a crucial facet of financial behavior patterns. Investment behavior is influenced by investors' psychological traits and market sentiment. Psychological traits of investors include risk preferences, sensitivity to losses, overconfidence, among others, which affect their investment decisions. Market sentiment refers to investors' emotional responses to market fluctuations and information, such as excessive optimism or pessimism, which may lead to market volatility. Additionally, financial behavior patterns encompass aspects such as debt management, savings, and investment planning. The financial behavior patterns of individuals or households reflect their financial concepts, values, and behavioral habits, which can significantly impact their financial health and future financial conditions. In conclusion, financial behavior patterns reflect individuals' attitudes and actions towards money and finances, influenced by psychological factors. Understanding and analyzing these behavior patterns contribute to enhancing individuals' financial literacy and formulating more effective financial management strategies to achieve personal and family financial goals. Financial education and psychology. The integration of financial education and psychology aims to enhance individuals' and society's understanding and application of financial knowledge by comprehending and applying principles of psychology, thereby improving financial behaviors and fostering financial well-being. Firstly, the fusion of financial education and psychology allows for a better understanding of individuals' financial behaviors and decision-making processes. By studying the impact of psychology on finance, we can identify psychological traits and biases people exhibit when dealing with money, enabling the development of corresponding financial education programs. Secondly, designing financial education courses based on principles of psychology can enhance teaching effectiveness. By understanding students' psychological characteristics and learning styles, we can tailor teaching strategies and methods to better suit them, thus improving their absorption and application of financial knowledge. Moreover, financial education can also assist individuals in managing and coping with financial stress. By teaching psychological skills and techniques such as emotional management and stress coping, individuals can better handle financial difficulties and challenges, thereby improving their financial health. Lastly, the integration of financial education and psychology can promote overall financial literacy levels for individuals and society. By offering comprehensive financial education, including theoretical knowledge, practical skills, and the application of psychological principles, we can help individuals better manage their finances, thus achieving personal and societal financial goals. In conclusion, the integration of financial education and psychology is a vital research area that can aid in better understanding and addressing financial challenges, enhancing financial literacy levels, and promoting the financial well-being of individuals and society as a whole. Improving financial behavior techniques. Improving financial behavior is crucial for enhancing the financial health of individuals and families. Here are some effective techniques. Set clear financial goals. Setting specific, measurable, and achievable financial goals is the first step in improving financial behavior. These goals can be short-term, medium-term, or long-term, such as saving a certain amount, paying off debt, or investing in assets. Create budgets and financial plans. Establishing budgets and financial plans helps manage income and expenses, ensuring the realization of financial goals. Regularly review and adjust budgets to adapt to life changes and changes in financial goals. Practice rational consumption. Learn to differentiate between needs and wants, avoid impulse purchases and overconsumption. Through conscious consumption, value-based purchasing, and comparison shopping, ensure that each expenditure is rational and affordable. Risk management. Be mindful of risks in investments and financial decisions. Diversifying investment portfolios, setting stop-loss points, and having insurance are effective risk management strategies that can mitigate potential losses. Build emergency savings. Creating an emergency savings fund can help cope with unexpected financial difficulties and expenses. It is recommended to save at least the equivalent of 3 months' living expenses as an emergency reserve. Continuously learn and improve financial knowledge. Learning financial knowledge, staying informed about financial news, and understanding financial products are important ways to enhance financial literacy, helping make informed financial decisions. Emotional management. Learn to control emotions and avoid letting emotions affect financial decisions. For example, refrain from impulsive actions during market fluctuations and maintain a calm and rational approach. Seek professional advice. When facing complex financial issues and challenges, seeking professional financial advice and opinions is a wise choice. It can help formulate more effective solutions. In conclusion, by following these techniques, individuals and families can improve their financial behavior, achieve financial goals, and establish a more robust financial foundation. Conclusion. The application of psychology in the financial domain offers a novel perspective to deeply understand individual and collective financial behaviors. Through the exploration in this paper, it becomes evident that psychology's influence on financial decision-making and behaviors is multifaceted, including cognitive biases, emotional impacts, social pressures, and more. These influencing factors shape individuals' financial behavior patterns, such as consumption, investment, savings, and significantly impact their financial well-being. In terms of financial education, courses designed with the integration of psychological principles can effectively enhance individuals' comprehension and application of financial knowledge, assisting them in improving financial behaviors to achieve personal and family financial goals. Additionally, a series of techniques for enhancing financial behaviors have been proposed, including setting clear financial goals, establishing budgets and financial plans, and practicing rational consumption. These techniques help individuals and families better manage finances and cope with challenges. Overall, the relationship between psychology and finance is inseparable. Understanding how psychology influences financial behavior and applying relevant knowledge and techniques are crucial for personal and societal financial health. Through continuous learning and practice, individuals can continually improve financial literacy and build a more robust financial future. Therefore, we advocate for individuals and institutions to pay attention to the integration of financial education and psychology, provide more financial education resources and training, and assist people in better understanding and addressing financial challenges, ultimately achieving financial freedom and a healthy lifestyle.